Hi everyone, time for another week 8 video. This week's video will focus on the trading week running from Monday the 8th of February 2021 to Friday the 12th. We've got a very light economic calendar coming up, so our main focus will turn to the overall market sentiment as well as the current global macro reflation narrative, which was very evident in price action this past week. Now, this past trading week has seen a broad-based continuation of the reflation trade, with some textbook reflation price action seen across multiple asset classes, such as upside for the S&P 500, equities overall, upside for oil markets, upside for US bond yields, as well as downside for the dollar. Now, the dollar did see some initial upside at the start of the week, mainly as a function of some positioning unwinding, but also moved back in line with that reflation narrative with a strong push lower on Friday after the NFP jobs report. Now, recently there's been more and more speculation among market participants that the markets are moving into bubble territory on multiple fronts, with some pointing to the disconnect between economic data and asset prices, others pointing to the current level of valuations, which are near or have surpassed prior bubble levels, some pointing to risk sentiment gauges that are pointing to extreme levels of risk appetite, others making mention of the recent retail frenzy that has sparked so much debate, and also others pointing to a possible dollar smile change in the dollar's outlook as a reason for trading a little bit more cautiously in terms of risk assets. Now, for those who are not familiar with the dollar smile theory, the chart on the screen will help. The dollar smile usually sees the US dollar gain strength during recessionary periods where we have a massive inflow in terms of safe haven appeal for the dollar. Think back to the global financial crisis as well as the pandemic. And then as Fed policy steps in and the rest of the world outperforms the US dollar usually weakens substantially, as was the case right after the global financial crisis, and of course is now been the case for the US dollar. And then the right leg of the dollar smile usually sees the US dollar gaining strength as the US economy starts to recover and outperform the rest of the world on a relative basis. So with that in mind, some analysts have argued that the incoming fiscal stimulus on the US front, as well as the vaccine rollout in the US, is possibly turning the attention back to relative growth dynamics, where the US could start to outperform the rest of the world, which might mean the recent lows in the dollar index reached at the end of last year could be the start of the next leg up in terms of the right leg of the dollar smile theory. Now, that brings us to the week ahead, where we have an extremely light economic calendar on our hands, which means focus will turn towards the ongoing stimulus developments in the US alongside the overall broader macro themes currently in play, like that reflation trade narrative. So with this week's main highlight only being really US inflation data, what we will be turning our attention to in the week ahead is on the US dollar as well as the VIX. Now, despite the dollar smile theorists flocking to the front lines this week, we think the recent upside in the dollar can be simply described as just some positioning unwinding. We shouldn't forget that US short bets was really one of the most oversubscribed positions in global macro coming into 2021. Thus, expecting a little bit of mean reversion and short covering at some stage shouldn't really have been that much of a surprise for markets. And the recent move that we've had to the upside in the dollar wasn't enough to really cause any real stress in other markets like commodities or emerging market equities and currencies. And that is usually a very sensitive market to the US dollar. But we should also keep in mind that a bigger squeeze, if we do get one, will be something to watch very carefully for these related asset classes, especially as both commodities and emerging market equities and currencies have been ripping in line of that reflation trade narrative. Now, the VIX is arguably one of the most important sentiment gauges that we need to be watching right now, and it will be a key focus point for us in the week ahead. The recent violent jump that we've seen to the upside in volatility on the equity side was very short-lived, and currently the VIX is right back down on top of a major support area coming in between 21 and 20. Now, according to a recent report from Deutsche Bank, systematic funds are still underinvested in things like equities right now, which is quite surprising given the recent price action that we've seen in equities. And you know what that means from a volatility point of view is if things like VIX and Nasdaq volatility, which can be seen in the blue on this chart, which is VXN, if that can finally take out key support and trade to new post-pandemic lows, that would be a huge tailwind for equities and could see some of those investors that's currently sitting on the sidelines on the bench to really step back into the game. Now, one has to argue that there's still a lot of positives in play right now. Things like the global vaccine rollout, very low base effects for economic data coming in, very low comparatives for companies, meaning that that can lead to a potential huge earnings acceleration. We also have ultra easy monetary policy still in place. We've got net short positioning in things like equities like the S&P, the CFTC data showing over the weekend, and also incoming fiscal stimulus. With all of these things in play, the question is rather when the VIX breaks lower and not necessarily if it breaks lower. Now, with the very light economic calendar, our focus will stay on our medium-term biases across various asset classes, starting with the euro pound. Our bearish bias for the euro pound remains firmly intact, especially after the Bank of England ticked both the boxes that we were waiting for and looking for last week by upgrading their growth expectations for 2021 and also pushing back against negative interest rates. Now, we've been taking chunks out of this trade to the downside with that bearish bias really from the 12th of January. And after taking profit after the BOE's decision, that BOE-induced sell-off that we had last week, we are flat in terms of positioning right now, waiting for pullbacks to either between that 88 and 88.70 area to take advantage of further possible acceleration to the downside. Turning to the US dollar, our medium-term bearish bias for the US dollar remains intact. However, the recent price action has sparked, of course, some concerns that we could see some additional upside in the greenback as the oversubscribed dollar short bets might look to cover some additional shorts. The majority of major pairs that we like, such as the Aussie dollar, the bias remains bullish. The pound versus the dollar remains bullish. Kiwi dollar versus the dollar remains bullish. USD CAD remains bearish, and all of them have reached some very attractive pullback levels with the dollar's recent push higher. But of course, on Friday we had a strong move lower in the dollar, back in line with that medium-term trends. And for now, we are staying very patient here on the US dollar until the recent short covering has more clearly run its course. In terms of equities, we maintain our medium-term bullish bias in equities, and even though the S&P is tech-heavy with 30% of the index weighted towards IT, it makes sense having exposure to the S&P as a balance between something like the Nasdaq, which is very tech overweight, and something like the Russell 2000, which is very cyclical and value overweight. And we also still maintain our bullish outlook on the FTSE 100 as both a value and a cyclical play, as well as some catch-up potential. Now, our trade plan for these equities will be once again watching the VIX closely. Any dips below that key post-pandemic support would be a major tailwind for equities. And given the current concerns about bubbles and valuation, a jump higher in the VIX, while equities are currently trading at all-time highs, could also be very violent. So we do want to keep that in mind for potential pullbacks. But even if we do see such dips, we would expect that to be seen as opportunities to buy at more attractive levels from the current equity bulls. Then turning to WTI, we maintain our medium-term bullish bias on WTI and Brent crude. Now, despite a stronger dollar for the biggest part of this past week, oil prices kept on rallying on the back of some positive inventory data as well as forecast upgrades from OPEC. And in terms of trade plans, after taking profit way too early in WTI last year, we've been waiting for significant dips to add back to long exposure, but we've been too conservative with our levels really until this week. And if we do find any dips towards that 53.90 as well as that $52 per barrel level, we would consider that as being buying opportunities, with recent support coming in at 51.70, providing a reasonable place to define some risk to the upside. Then turning to fixed income and the bond market more specifically, markets are still expecting steepening curves throughout 2020 in line with that reflation narrative of higher growth and of course higher inflation expectations. And that means that fiscal stimulus developments as well as US CPI coming out this week will be very important for something like the bond market, and more specifically the US 10-year in the week ahead. Now, our trade plan, one of our preferred ways of expressing further upside in US 10-year as well as steeper curves, is really on the short side of gold. And for those following along with us in the terminal will know that we've been taking chunks out of that recent push to the downside in gold over the last couple of days and weeks, and we will continue to look for opportunities to get short on something like gold by keeping a close eye on price action in both US 10-year, the US dollar, and of course the important one from a trigger point of view, GBZ, which is gold volatility. Okay guys, that is everything from my side for this week ahead video. I hope everyone will have a fantastic trading week ahead. And if you want more information and a helping hand for these or other market related themes and biases, make sure to check out the website and join us for a free 14-day trial for the Financial Source Trading Terminal.